Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Joining me tonight, Montgomery from RogerMontgomery.com. Now, Roger, I would have thought that Monday, Tuesday last week, your rating system would have lit up by a Christmas tree for a couple of days there. Is that what happened? What were you doing?
I think you're absolutely right, Chris. And in fact, we were talking about it before the show started, Ben and I, and we were absolutely doing the same thing. So we invested probably $35 million in the market, which is about almost 30% of our fund, just in those sort of 3 or 4 days, I guess. You know, where it was really.
Did you spread it wide, or did you? We never spread ourselves too thinly. We go for the companies that we've been talking about on this show now for a year. And what was really interesting, I thought, it was that those lows were then followed up by some really good results for the full year by many of the companies that we'd bought shares in. So I was delighted to see that. Just on the United States situation, I think it's pretty simple, that the framework that you can work with for it. You've got to understand that in the United States, they haven't abrogated their ability or the willingness or the ability, more than anything else, to print money. In Europe, individual countries have lost that ability to print money. And so that means they're going to have to face tough austerity measures, whereas the United States can just, for want of a better description, just accelerate its way out of it by inflating its way out and printing more money. That's really their only solution. I think there's a lot of short-sighted comments and a lot of ignorance about how the United States can get out of this. Just remember, they don't have to pay all their debt off. You know, it's like if I borrow $1 million to go and do something, well, maybe I'll feel a little bit overwhelmed by a debt like that. You know, if I'm speaking for most people, they would. But then if I get to the point where I've still got $200,000 or $300,000, but I paid the bulk of it off, I'm okay. So they'll never have to pay all of it off, but the simple way to do it is to just inflate their way out of it. I suspect that's what's going to happen. And like Ben, I absolutely think that despite the fact that trendline growth in the United States is now close to 1%, and if you overlay if you draw a horizontal line on a chart at 1%, just above zero, and then you overlay the business cycle over the top of that, well, every time you get a slowdown in the business cycle, everyone's going to freak out and think there's going to be a recession. Now, there will be. You know, we will get more frequent recessions just because trendline growth has gone from 8 or 9% just after World War II to where it is now. And there will be, if there's not more frequent recessions, there's the fear of more frequent recessions. But of course, when things turn up again, people say, oh, it's over and it's happy days. And the market will rally again. We've still got almost 70% in cash because we don't believe that it's over. And it could be the market rallies for another 6 months. I don't know. Please don't ask. No one call. No one call and ask me where the market's going, because I don't know. But I think if we continue our disciplined approach to buying good quality businesses, and we should talk about these results, you'll do okay. All right, good stuff. Thanks for that, boys. Listen, we'll go straight to Greg, who's waiting on from Perth. Hi, Greg. How can we help you?
Oh, yes, could I get some information on Forge Group, please? FGE?
Yep, you certainly can, Greg, and I think you've rung at a good time tonight, because I have a feeling that this might be one of Roger's stocks that he likes to have a look at. As a guest.
I've just tuned into the program,
You've
Chris.
just tuned into the program, that's okay.
No one had plugged me in.
No, you're right. We've got Forge Resources.
Oh, yeah, okay.
So I'm pretty sure this is
Forge
Group, is it? So this is one that I think you've discussed before. It looks like it's come off the low there, down at 450 in that correction, back to 550. Was this one of the ones you bought last Tuesday?
Yes, it is.
Yep.
We did buy a little bit. I would always, after a rally like we've just seen, you from 450 to 550, you always wish you'd bought a lot more. There's no doubt about that. But Forge is an A1. You know, it's an A1 business. I've talked about it on many occasions on this program, and it's probably our favourite out of sort of matrix composites and engineering, Ford and Decmil. We like it. The result was excellent. Intrinsic value is, I'll pull that up for you right now. I've actually got it at $4.42.
Right, yeah.
So bear with me, sorry.
No, you're right.
No, not $4.42, $6, over $6.
$6 much better than $4.42. That's
sorry.
excellent. No, you're right, mate.
I'm not plugged in anywhere. So yeah, just it's over $6. So I'm pleased with that, and that's rising to possibly $8 by 2013.
All right, no trouble.
This out of all the
sort of what are regarded by some investors as sort of the second-tier mining services companies, this business is at the top of the list. It's in line to be the next Monadelphous potentially.
Straight to Abe. Thanks for calling. Abe, what's your question tonight?
Thanks for taking my call.
Anytime.
Since you're on mining engineering, I'll ask you about Macmahon Holdings. There's been some contract signed lately, and it's had a bit of upswing. I'm in at 70 cents. Do you think I should bail out?
Oh, okay. Listen, thanks very much for your question,
Just
Abe.
on Macmahon first. I've got some research here from, we get, as you do, all the research we all get it. It all comes across our desks, and I know that there are brokers who are perennial buyers of Macmahon, but when I sort of stand back and I have a look at this business, its intrinsic value this year I've got it at 41 cents, and I think it was 38 cents back in 2003. So if you subscribe to the idea that you should buy businesses whose intrinsic value is going up because you believe that while in the short term prices can do all sorts of crazy things, but in the long run prices tend to follow the value of a business, if you believe that and subscribe to that, well then this business is not going to deliver sustainable long-term outperformance. In fact, the share price now is not much different to what it was back in 2005, and it's gone up and down quite violently in between. Decmil is a terrific business, and I'll give you. I mean, I know it's an A1, it's one of our few A1s. We've got 56 of them, so that's not many. But it isn't cheap. Oh, sorry, it is cheap. It wasn't cheap just a couple of months ago. It was really quite expensive, and it had got well ahead of itself.
$3 or something there at one stage.
And I just have to. I just want to talk to some of the viewers who I know follow some of the conversations I have here and on the blog about companies. I'm under no obligation to tell people that I've changed my view, and so unlike a broker who's sort of got to put this stuff out all the time, it's really not in my interest to do that. And so it's been above its intrinsic value quite substantially recently, but now it's come back, and I value it at $2.56, and it is an A1 business. It's an A2 business. So it's a terrific company. I do prefer Forge. In the short term, just now, but longer term, I think both of them are going to do fine.
All right, good stuff. Thanks very much for that. So, Abe, I think there might be in this market, a lot of value out there. There might be a few things to do other than in Macmahon, but we've got Ken waiting patiently on the line from Brisbane. Hi, Ken. How can we help you?
Oh, g'day, Chris. Thanks for that.
No trouble.
If possible, could the panel tell us what shares they bought during the recent downturn? I think they've probably answered some of the questions.
Make you list what's in your fund. Let's have a little focus here. Oh, no, now I know. No, but why don't you give us a comment on sort of the top 10, like the few of the banks. No, not your top 10. Not your top. No, I'm just kidding. Not your top 10 stocks. Like the
what
four banks, BHP, Rio, or
Yeah, so we didn't buy Rio or BHP, but we bought JB Hi-Fi,
right, okay.
which has done extraordinarily well. I thought their result was very, very good. We bought ANZ and CBA just as you did. Mind you, I didn't know. It's not like we
No. You didn't know where it was.
What are you wearing today to school?
No, I rang you in the morning. Don't you remember?
We bought a little bit of Flight Centre. We bought some Woolworths, Credit Corp. We bought some Credit Corp. We thought their result. Their result was very good. What else? Forge, which we've talked about. GR Engineering, which Ben mentioned earlier, and
Linus?
No, we didn't buy Linus. Why did you say what?
I was just interested because you were saying you were starting to come around to it. It sounded like the last few weeks.
Yeah, but there's other things to come around to faster. CSL.
Yes.
Was another one.
Well, better talk about that because CSL. I thought the result was okay today, and it was down 3%.
Yeah, but who cares?
I don't know. It doesn't matter. But I'm saying, were you happy with the result?
Very happy. I thought it was a great result. Cochlear's result was excellent as well. I mean, they're the two, A1s amongst A1s. CSL and Cochlear in Australia, just amazing businesses. And for whatever reason, people don't like them. They go through periods where they don't like them.
Excellent. Thanks for that, boys.